We had sellers in gold and silver. They sold silver off and gold enough to nip out. It's a bear trap once you do it. The low today, just below 75. Now we're trading 77, 78. Start to see it moving back up as 100 in silver. And people will then start to pull their hair out because I thought we're going to 50. 3 monthly bars, you're going to see an enormous explosion in silver and a good strong move in gold, but silver especially. I think silvers will go into that range, 3 to 500, and there are about half a dozen different reasons to argue that case. Gold to be $8,500. And that's merely doing what it did twice before. So sort of say, oh hum, gold did it again. JP Morgan some months ago, fundamental analysis, and came up with 9,200 as a likely place for gold. It's going to go there, but it's probably going a lot further. The loss of confidence in the central banks. We may not have a Federal Reserve in 2 to 3 years, is my expectation. Once we hit this crisis, then just repeated boom-bust cycles. Monetary expansion, stock market goes up, stock market crashes, and they print more money. It's a bubble. Jamie Dimon 2 weeks ago said, this time we've got a government bond crisis. We're going to have to deal with it.
Silver to 3 to 500 and, potentially gold's above 8,000. Is that still what you see on the horizon? Do you think it can go higher?
I think it could be very rapid. In fact, our assessment is that it will be very rapid. The issue is coming out of this congestion zone. And, everybody, every time silver drops, they pull their hair out, say, oh, it's terrible. Well, here's the situation. If you chop off that brief period of time where above 100, we get up to 120 in silver late January. It's like several days or so. And look at what's happened. In fact, the high weekly close for silver has been $100, just above 100. But if you take the action since late January through the present, so 6 weeks, you had the collapse January 31st and February 3rd, really a day and a half collapse that was most of the decline. Silver dropped to $66 by February 3rd. Okay. Look what happened since. Silver shot back over 90, came back down into the 70s, back over 90. And then with the war news, in fact, there were 2 or 3 punches up above 90 where they sold it repeatedly, 90, 90, 90, okay. Then the war news came, and we had sellers in gold and silver. And they sold silver off and gold enough to nip out the February obvious to everybody chart low. In silver, it was 66. So on March 23rd, after multiple sell-offs that didn't get back to that low, you finally had one that flushed it.
Silver collapsing to $66 looked like panic, but repeated rejection near $90 may say more about positioning than weakness. Michael Oliver notes this 6-week compression after the January breakdown resembles a battle around trapped liquidity, not broad investor surrender. Repeated failed breakdowns often expose where large money absorbs fear, while retail reacts to headlines. For wealth holders, consolidation after violent selling matters more than emotional narratives around war or volatility. Next, Michael Oliver exposes why repeated selling near resistance may hide accumulation, not exhaustion.
We expected that. Several weeks before that flush, we put out a report arguing, especially that gold was going to take out its low that had occurred in early February. But don't believe it. It's a bear trap once you do it. I mean, it's just going to do it and then go back up. Okay. Both metals went down on March 23rd and took out the February low. And no doubt there were so many sell stops that were hit by people who simply looked at the price chart and said, God, if we take out the Feb low, I'm gone. Okay. And so the number of sellers between $66 and $61 silver was no doubt enormous. It spent about 2 hours below that low. You can go to an hourly chart and see what I'm talking about. And within days, it vaulted $10 up off that low and ultimately went back to 90 again. And now we've pulled back. And where do we pull back to? Well, if you measure silver from that range, that plus 90 range, which most all the high recovery highs have occurred since that isolated peak. And you go back and look at the lows where it was 61, 60, 60, 66, 61. Okay. So in the mid to low 60s is your lower end. And the upper end of all the activity since the January 31st drop has been above 90. So you got like a $30-some range there. Well, this pullback was about halfway into that range. The low today, just below 75. Now we're trading 77, 78. So we didn't even get back to the low end of the range. I don't think we're going to it.
False breakdowns often hurt disciplined investors more than reckless ones, because stop losses become liquidity for stronger hands. According to Michael Oliver, the March flush below prior lows mattered because silver spent only hours there before sharply reversing. Historically, failed breakdowns can reveal intent, shake out weak positioning, then reclaim structure before sentiment catches up. Savers watching price alone often miss when recovery depth becomes shallower, signaling demand beneath volatility. Next, Michael Oliver reveals why this mid-range pullback may contradict the bearish chart narrative.
I think that was it. Okay. We already argued that there's enough short to intermediate term technicals that say this particular rally since that March 23rd low is real, that you're coming up out of here this time. And we think that even though it got sold into again for the fourth time above 90, that $90 crowd is about to get blown out. Okay. This upturn we're seeing today from today's low, if it persists, and I think it will, you ever get back above 90 again, you're going to see something dramatic occur. You're going to start to see it moving back up as 100 and so forth. And people will then start to pull their hair out because I thought we're going to 50, It's on the other side of this congestion zone that within, I think, about 3 monthly bars, you're going to see an enormous explosion in silver and a good strong move in gold, but silver especially. And also in the miners. The miners are doing better than gold, by the way. People doubt that, but you can measure it and it's a truth. And silver is now beating gold as well. Ever since November of last year, we had a breakout saying that, okay, if you want to own gold or silver, silver's the one now. It's been a dog for 10 years. It was capped off against gold. It broke out in November, and that spread is still quite firm and has hardly flinched over the last several months. It's held its ground. I think I think it will go into that range, 300 to 500, and there are about half a dozen different reasons to argue that case.
When an asset repeatedly fails to break lower while outperforming its peer, that divergence can quietly reset portfolio assumptions. What Michael Oliver is highlighting is that silver strength versus gold and miners may reflect internal leadership, not speculative noise. Leadership shifts often appear before broad public recognition, especially after long underperformance cycles. For investors protecting purchasing power, relative strength can matter more than headlines predicting collapse. Next, Michael Oliver unravels why silver leadership could expose a deeper rotation most retail investors ignore.
And how sustainable do you think this silver rise can be? Because the challenge is, I think at one point the ETF had more volume than the S&P ETF, so there was obviously massive speculation and massive
I think it's different
push into it.
I don't think we get a normal bull market in gold. This is not normal. Okay, we have a potentially we have government bond markets, major governments. We're not talking, some country in Africa or some small country in Asia. We're talking about Japan. We're talking about the US. We know the UK is in trouble. You can't have this and it be, a passing thing. This is a massive glacial nuclear event in terms of market assets. And once the perception is that it's a so-so situation, and we know that, the chief investment officer of Chase, I think it was Chase, pardon me if I'm wrong, said 3 or 4 months ago that the 60-40 rule is no longer applicable. 60% bonds, 40% bond orthodoxy, allocation of assets. We now need to introduce gold into that. 20% that, 20% bonds, 60% stocks, which was a heck of an admission. And it probably should be weighted more. Here's what I think technically and fundamentally is going to happen. This next bull move in gold and silver, one, will take silver to a new reality. 300 to 500, let's say, maybe even beyond. And sure, you'll have a sharp sell-off somewhere up there, but it ain't coming back to 50 again, okay? You might have a sharp sell-off, but you'll end up being in a new reality, like between $200 to $500, no longer 4 to 50 for 50 years, okay? And that new reality, and same with gold.
Markets can rally while confidence underneath the bond system quietly fractures. Michael Oliver's argument suggests this may not resemble a standard commodity cycle if sovereign debt stress is influencing capital behavior. When institutions reconsider long-standing allocation models, the official normal market narrative weakens fast. That matters because retirees and savers relying on traditional diversification may be exposed if bonds stop behaving like safety. Next, Michael Oliver exposes the contradiction between safe haven language and weakening confidence in government debt.
And I pointed out before that gold, just to match the dimensions of its prior two bull markets, the one that peaked in 1980, the one that peaked in 2011. Higher highs, higher highs, higher. They were eightfold gains from bear low to bull high, bear low to bull high. If we go eightfold just to match those bull markets, gold would be $8,500. And that's merely doing what it did twice before. So sort of say, ho hum, gold did it again. Well, we've got a fundamental reality that is far different than then, okay? And so don't expect gold just to go to 8,000 again. I noticed that JP Morgan some months ago had a fundamental analysis and came up with 9,200 as a likely place for gold to go. Well, it's probably, yeah, it's going to go there, but it's probably going a lot further. But that was interesting on their part that they came up with a target that was sort of like that eightfold gain thing. The reality is that the financial stability of the Western world is in question because of the government spending and this constant process of debt accumulation, and the bonds becoming effectively, pieces of paper. Well, that's what they are, okay? And if suddenly the investment public perceives them to be not the stability that they were, then good grief, it's 52 card pickup. Reality's changed. Institutions will be in question. Central banks will be in question. Fiat currencies will be in question because they're reflections of that paper process. And when people undergo the pain that's associated with that regurgitation of unreality, all kinds of things change, including concepts and notions that are acceptable.
Historical bull cycles can become dangerous when investors assume past scale guarantees future stability. This is where Michael Oliver's thesis shifts from price projection toward trust in the broader financial structure. If debt expansion keeps eroding confidence, gold may become less a trade and more a judgment on monetary credibility. For long-term wealth protection, the real risk is assuming paper systems behave normally during structural strain. Next, Michael Oliver reveals why rising gold targets may reflect deeper institutional distrust, not just bullish momentum.
So expect a new reality on the other side of this, one that entails the loss of confidence in the central banks. We may not have a Federal Reserve in 2 to 3 years, is my expectation, once we hit this crisis, because there'll be a perception that, hey, this game hasn't worked for 110, 15 years. It's been just repeated boom-bust cycles. Monetary expansion, stock market goes up, stock market crashes, et cetera, and they print more money. It's been a game, and it hasn't done any good because actually the stock market has not really made any money in terms of money growth, okay? So anyway, the answer is to that, expect this bull market to end up at much higher levels. Yeah, there could be sharp sell-offs after that, but they'll be in a different reality. But there'll also be an outside context that will change such that the monetary metals are no longer viewed as, quote, precious metals to trade. They'll be viewed as money, which they've been for 3,000 years. I think the Chinese recognize that based on what they've been doing for several years. So anyway, that's my answer to the question, what will happen on the other side of this? A new reality. You got this blue horizon in terms of global stability issue, which is a false driver of gold. That's not what drives gold. And then there's every reason to be owned in the stock market, right? What if it goes down during that time when everything's great? That's our expectation, because what's not great is what's underneath the stock market. It's a bubble. We've got a government debt crisis. Jamie Dimon 2 weeks ago said, okay, this time we've got a government bond crisis, and we're going to have to deal with it.
A market can hit new highs while confidence underneath the monetary system quietly erodes. Michael Oliver notes the deeper claim here is not just higher metals, but a shift where gold and silver may be treated less as trades and more as monetary protection. That directly challenges the mainstream framing that rising equity indexes automatically reflect real wealth creation. For long-term savers, debt expansion and asset inflation can disguise declining purchasing power. Next, Michael Oliver reveals why a bond crisis may matter more than stock headlines.
He wasn't talking next 2-3 years. And his comment happened to be well-timed with our assessment that the bonds are now going to slip into the depths of the unknown. And sure enough, in the last several weeks, it's done enough to where we're back on the price lows of multiple year price lows, multiple year yields. And that is not friendly to the Fed. So everybody's saying the Feds have got to raise rates because inflation. Well, inflation is the growth in the money supply. That's how they manipulate reality. They've got a government bond crisis that has to be defended, meaning they got to buy that stuff. And that means print, okay? So the argument that the CPI matters, no. CPI is merely a reflection of monetary expansion. They got to deal with the bond crisis. And that's not a prime subject on financial TV at all.
How low do you think they'll let the prices, or how high do you think they'll let the yields go? Is it sort of at that stage where it's in critical territory?
I think they've already been buying, according to Williams, New York Fed chair, head of President New York Fed. He said last November that the Fed was now going to start buying bonds, quote unquote. And his reason was, just to provide liquidity. Right. Yeah, it's to defend the bond market. So they knew the government bond market was not in good shape then. We knew it too. But now it's technically gotten to the point where we're at the edge of the precipice. In fact, we think we've crossed the edge.
The Fed talks inflation discipline, yet bond stress can force the exact opposite response. According to Michael Oliver, the real pressure point may be sovereign debt defense, not CPI headlines dominating financial television. If liquidity support quietly returns while rate rhetoric stays hawkish, the contradiction exposes how policy language and balance sheet behavior can diverge. Investors relying on safe bonds could face risk from both declining prices and monetary debasement. Next, Michael Oliver exposes why defending bonds may require actions that publicly deny inflation fears.
And so you've had sharp weakening in price in bonds over the last couple of weeks, especially. And they're now challenging all the price chart lows you could find on TLT or T-bond futures, or the high yields on the yield charts. And that's where suddenly investors, asset managers, governments who might be buying our bonds or less so, have to get concerned. And so that's when the Fed has to do something about that. And that means not raise rates, okay? So anyway, whatever. If they raise rates, that's fine. It just makes it worse. Then they get a worse crisis. So you can place your bet how you want. Our bet is they're about to engage in print through this or that tool. And that means more money flow, but money flow, if it doesn't go in the bonds and doesn't go into the stock market, where's it going to go? Okay. We know there's an answer.
As you said, China's been accumulating lots of precious metals, basically all the BRICS countries have. Do you think they'll be winners from this situation, or?
Well, they'll definitely be less victimized by the events. Yeah. Because the more they've moved into money, gold and silver. I think the Indians are talking about silver as a currency or something, as backing the money unit. But these countries that have moved more so back into gold, real money, will be at a far better position of stability to weather a global depression. And I don't think we're headed for a recession, by the way. When we go down this time, it's going to be more like the normal metrics will say, well, this is a depression. We'll see. But the main thing is that who is less the victim of this downturn?
When bond weakness reaches multi-year extremes, capital rarely stays still for long. What Michael Oliver is highlighting is where redirected liquidity could move if trust in bonds and equities both weakens at once. Historically, money flows toward perceived monetary safety before retail investors fully understand why. That matters because countries accumulating hard assets may face less systemic damage than those dependent on debt-heavy paper confidence. Next, Michael Oliver unravels why liquidity shifts may reveal institutional fear before headlines admit it.
And right now, the bubble US stock market puts it into one of the worst positions of most stock markets in the world. Japan is a bubble market as well. But a lot of stock markets, even Europe, has not had the same kind of bubble gain since 2009 that we've had. Yeah, they're going to go down hard too. They're a part of a global economy. Even Shanghai Composite, even though it's only double and a half in gain since its 2009 low. And it's in a bull trend, but it's not a bubble. And therefore, yes, if it participates in a global downturn in stock assets and in the economy, sure, they're linked to the world economy, so they'll likely weaken too, but they don't have the bubble negativeness built into them in terms of even their stock market pricing. It's not a bubble. Yeah, I can have a bear market, but it's not a bubble. So, and they're in a better place, and any country that has been accumulating gold more so than the Western world is in a far more stable position to weather this.
Rising markets can become most dangerous when investors mistake stretched pricing for strength. Michael Oliver's argument suggests the bigger divide is not which markets fall, but which systems enter downturns already inflated by excess confidence. A correction inside a non-bubble economy is different from unwinding leverage built on years of asset expansion. For retirees and wealth preservers, geographic diversification without understanding structural risk can create false security.